IBM Capital Budgeting by Julia Amar. IBM remixed its business in order to strategically position itself to focus on high-value opportunities. It stopped offering commodity products such as PCs and hard disk drives and focused in areas such as service-oriented architecture, information on demand, business process service, modular system for businesses of all sizes, business intelligence and analytics, visualization, and game solutions. Also, it acquired more than 100 companies that complement and improve IBM's portfolio of products and offerings. Secondly, IBM has invested heavily in order to become globally integrated enterprise. As of 2009, IBM operated in more than 170 countries. It increasingly focused in making investments in growth markets such as the BRIC countries. Regarding pre-tax income, it is possible to see that it has been constantly increasing since 2002. IBM has added more than $11 billion to their pre-tax profit, which increased their pre-tax margin 2.5 times. Similarly, earnings per share have increased by more than 4 times since 2002. Regarding free cash flows, they also have been increasing since 2002. Total free cash flows in 2009 totaled $15.1 billion. IBM has doubled the amount of free cash flow since 2002, having generated about $80 billion. In 2008, IBM invested $6.3 billion in 15 acquisitions, with 10 of them being in key areas of software. Also, it invested $4.5 billion in net capital expenditures. More than $13 billion was returned to shareholders. IBM spent $10.6 billion on sales repurchase and $2.6 billion on dividends. In 2009, IBM increased the amount of dividends paid to $2.9 billion, which represents 10% from the previous year. The hardware segment used to represent 24% of IBM's business mix. In 2009, it only represented 7%. In a minor scale, investment in financing also was reduced, decreasing its portion of the business mix by 2%. These segments were replaced by increasing investments in service and software segments. By 2009, both segments had the same weight of 42% of the business mix. The investment in services increased by 2%, while investment in software showed an increase of 17%. The Standard & Poor's rates IBM's senior long-term debt as A+. Its commercial paper has a rating of A-1. In 1995, IBM authorized a repurchase of all outstanding preferred stock. Therefore, there is no rating for preferred stock in IBM's annual reports. In that one-year period, the total investments in RD&E decreased by 8.2%. This decrease was driven by continued process efficiencies and reduction in discretionary spending, partially offset by the impact of acquisitions. Within the total RD&E investment, software-related expenses also decreased in 2009 by 12% from the previous year. This decrease could be associated with a charge of $24 million in 2008 for acquired IP R&D. From 2008 to 2009, total shareholder equity increased by 40%. This major change is driven by an increase in many categories that make up shareholders' equity. Net income for 2009 was $13.4 billion, which means retained earnings increased by more than $10 billion. Besides, in 2009, the company experienced a net gain of $994 billion, while in 2008, IBM experienced a net loss of $15.2 billion. This means total other comprehensive income increased by more than $21 billion. In 2008, IBM experienced a loss in other comprehensive income of $18 billion. In 2009, this was a gain of $3 billion. IBM has 5 major segments: Global Technology Services, Global Business Services, Software, System and Technology, and Global Financing. Regarding the performance of each segment, total revenue for all the segments decreased compared to 2008. However, Total pre-tax income increased when compared to 2008 for all segments. This suggests that the expenses associated with each segment decreased in that one-year period. IBM operates in many different countries around the world, dealing with multiple functional currencies. Therefore, it faces a high foreign currency exposure. In order to limit its exposure risk, the company uses many different hedging strategies. In order to reduce its risk, IBM basically takes advantage of exchange rate forward contracts in order to eliminate volatility and lock a specific exchange rate for future transactions. Also, the company takes advantage of cross-currency swaps in order to convert fixed-rate foreign currency denominated debt to fixed-rate debt denominated in the functional currency of the borrower entity. The financial instruments that are included in the sensitivity analysis include all of the company's cash equivalents, marketable securities, short-term and long-term loans, commercial financing, installment payments, receivables, investments, all long-term and short-term debt, and all derivative financial instruments. The company's portfolio of derivative financial instruments generally includes interest rate swaps, foreign currency swaps, and forward contracts. To perform the sensitivity analysis, the company assesses the risk of loss in fair values of the financial instruments shown above due to hypothetical changes in the interest rates and foreign currency exchange rates. The company computes the present value of the future cash flows that would occur in each scenario affected by the changes in rates. These values make the market value for interest and foreign currency exchange risk. The discount rate used for the present value computations were selected based on market interest and foreign currency exchange rates in effect as December 31 of 2009 and 2008. The differences in this comparison are the hypothetical gain and losses associated with each type of risk.